I'm Christopher Tate and welcome to my random thoughts for the 30th of October 2008. Now, before we begin, the usual piece of housekeeping. Anything presented in these short lectures is of an educational nature only. There is no personal or specific investment advice given. The content is purely general and is purely educational. Should you require any form of investment advice, you will need to see a licensed investment advisor for that advice. Now, the first thing I want to talk about is the extension of the ban on short selling, and that this extension has occurred despite the ban being lifted in the United States. My view is that the ban has been put in place because regulators don't understand two things. They don't understand the role of short sellers in the market, and they don't understand the role of volatility in the market. Now, with regard to short sellers, there is this belief, and it's a belief held by regulators, but also by a lot of people who wear tinfoil hats, that short sellers somehow send businesses broke. That's not true. What sends businesses broke is poor management and poor business practices. Short sellers have no control over those things. Short sellers are merely aware of those things and take advantage of them. Now, what we've been seeing in the past few months is a host of industries with poor models and poor management going under. Those companies have then bleated that this is somehow the fault of the short sellers who've done this to them. It is not. It is the fact that many of these people running these companies could not run a Mr. Whippy van properly. That's what has sent them broke. It has not been the role of the short seller. Short sellers provide a vital function within markets. They provide both liquidity and price discovery, but intriguingly, they also put a break in the market. This break occurs because of the need for short covering. If I short sell an instrument, there comes a time when I need to buy it back. When I go to buy it back, I have to step into the market and physically place a buy order. Now, if a lot of short sellers have sold an instrument and move into the market to buy it back, the only way we can compete with one another is via price. We have to outbid one another. That means we have to bid prices up. We are putting a break in the market. But not only do we put a break in the market by our own activity, what can occur is that we trigger other people to buy, because as we push prices further and further up, this launches buy stops of other traders. So not only is there now a break in the market, there is now an upward drift in the market. And it seems as if regulators have completely missed this point and failed to understand it. And in effect, what we are seeing, and this is the cynic in me talking, we are seeing regulation for the few. We are seeing industries that the market knows have poor business models and poor management being protected from the consequences of those actions. And those consequences arise by a drop in the share price. And we are being forbidden from A, discovering that fact, and B, profiting from that fact. To my mind, this is intellectually, philosophically, and morally incorrect. You cannot have a lopsided system where people can benefit from the upside of their actions but not suffer the consequences of the downside of their actions. One of the cornerstones of capitalism is the capacity to fail. It is my right to try a business venture and then to fail if I'm not very good at it. It is not the government's role to step in and interfere with that process. And it is not the government's role to step in and interfere with traders in any way, shape or form. The other point that regulators don't seem to have very much of a handle on is the notion of volatility. This applies equally as well to both traders and financial journalists. Journalists will often talk of volatility having a bias, of having a direction. This is not true, and it represents a fundamental misunderstanding of how the world works. This misunderstanding of volatility is particularly true of the peanuts that appear on cable TV. They are constantly talking about volatility in a given direction. Now, as a short refresher, volatility is simply the speed and magnitude of a given price movement. It is not trend, it is not direction. If I say to someone that I have bought something at $1 and it has a 30-day historical volatility of 20%, the only judgment they can form from my statement is that at some point in time during a 30-day window, you will have a reasonable expectation of price being between 80 cents and $1.20 in very simplistic terms. Volatility does not tell you direction. Volatility is akin to me saying that my car is doing 100 kilometers an hour. That conveys no other information other than the fact that I am travelling at 100 kilometers an hour. It doesn't give anybody an indication of the direction I am travelling in. It is a descriptive metric simply for speed. Volatility is the same, except we have magnitude included. This means that there is no such thing as upward volatility. Volatility has no bias, it is not trend. Likewise, there is no such thing as downward volatility. Just because prices are heading down does not mean they are more volatile. For example, the US dollar index futures contract had been going down continuously for almost 3 years, but displayed very, very little volatility. That's because trend and volatility are not the same. Now, to give you an indication of how the ban on short selling has affected volatility, one of the members of my mentor program produced this very, very clever chart, which looks at volatility as a function of price on the All Ordinaries, and it looks at that period of time before and after the ban on short selling was brought into play. And what you can see is that post the ban being introduced, volatility exploded. Now, this was also found in the US. Stocks that were protected had their volatility go up dramatically when they could not be short sold. This is because short sellers are not in the market to provide liquidity. They're not in the market to act as a brake. Once you remove that market function, you will see an increase in volatility. And we will continue to see an increase in volatility in our market in these instruments until the ban is actually lifted. Now, you'll also note from this chart that volatility and trend are not the same. Volatility describes speed and movement. Trend describes direction. We have an uptrend, a downtrend. There is no relationship between the two, and to suggest that there is to misunderstand how volatility actually works. Now, in terms of trend, this very interesting chart was produced also by someone in my mentor program. And what it looks at is the long-term upward drift in the All Ordinaries. Now, this has been plotted as a semi-log chart. Plotting long-term charts as semi-log charts removes some of the distortions you get from disparities in movements of equal size. For example, let's say the index moves 1,000 points. Now, if my starting point is 1,000 points and the index moves 1,000 points, that's a 100% gain. But if my starting point is 5,000 points and the index moves 1,000 points, that's only a 20% gain. Plotting charts as semi-log removes this disparity between relative versus absolute movements. This chart shows us an interesting thing. It shows us the channeling of the All Ords over time. Now, indices have an upward bias. They have an upward bias because of a thing called survivor bias. And I've spoken about this before. When you go to financial planners or stockbrokers, they will always make the remark that markets always go beyond their previous high. That may or may not be true. But the problem is that as an investor, you will not buy the index. You will buy a basket of shares. Now, I can guarantee you that if I'd bought a basket of 20 shares back in 1979, that they would not have shown the same degree of increase as the index itself. At a guess, I would suggest to you that half of them have probably disappeared, whereas the index has continued to move upwards. This occurs because non-performing stocks are dropped from the index. They're thrown out and replaced by performing stocks. This chart also gives an interesting insight into the crash of '87 versus the crash of 2008. To use a sporting analogy, the crash of 1987 was akin to a first-round knockout. Granted, the market had been drifting down for some time and had already peaked before the '87 crash. Now, if you did not take the very prominent and very powerful sell signal on the Friday before the crash, come Monday, you were in trouble. It would have been very, very difficult for you to exit your positions. Contrast that with this year. This year you've had 8 months to do something about your plight. Yet, intriguingly, many traders have refused to accept that the market has actually gone down. This is particularly true among fund managers who, for some reason, seem to be blind to the fact that the market stopped going down in January and began to fall quite precipitously, and in the past few months has dropped like a stone. Now, this harks back to the notion that you need to listen to the market. The market will tell you everything you need to know. How you trade what the market is telling you is your own perspective. That is a reflection of your own trading system. But if you stop to listen to what the market is saying, then it will tell you everything you need to know. The problem is many people have a view of what they think the market should be doing rather than what it is doing. And these two views are diametrically opposed. One is based in reality, one is based in fantasy. The notion that you can impose your will or tell the market what it should be doing is akin to some form of mental illness. You're not quite right in the brain box if you think you can influence the market. And this is reflective of the very, very, very poor returns of traders who think they can tell the market what it is actually doing. Take, for example, the notion that if we look at this chart, the lower boundary of the channel seems to indicate some form of support at 4,000 points. Now, irrespective of the reason as to why that is, it may be that traders have a psychological resistance to pushing through round numbers. There may be a belief system that the market represents value at 4,000 points. It may be that all the negative sentiment that has been pounding the market for the past 8 months has finally washed out of the system. Irrespective of how you arrive at that view, the reality of the situation is that the market is now sitting around the 4,000 point mark. What you do with that information is a reflection of your trading system. You may think this represents a point of resistance and you are a buyer from here. You might think that the market will fall through this point and you will be a seller at this point. But irrespective of what occurs, your view must reflect the reality of the situation. Now, there's a few key points that I want you to draw from this. 1. Granted, the ban on short selling is annoying and is an interruption to our business. One of the things that I hold as a firm belief system as a trader is that any failure that occurred to me or any damage that was done to my trading business would be the result of my own actions. what we've now actually seen is that this is not quite true, because portions of our trading environment, of our ecology, can be cut off from us, and we have to think laterally. In this respect, we need to diversify. Look at other tools. Granted, you cannot short sell National Bank, but you can buy a put option, sell a call option, or you can short sell the finance sector. Secondly, understand volatility. You do not have to be a statistician, but you must understand what it means. This is particularly important for people who trade options. Volatility is integral to the understanding of options and options trading. Yet so many people do not understand volatility and its role in options. This leaves them open to making mistakes. But as I say, you do not have to be a statistician, simply understand what is occurring. And finally, understand the big picture. Take a step back. Understand what the market is telling you. Now, traders are often very good at trading tactically, and by that I mean they can run their scans, place their orders, move their stops, but they cannot take a step back and view the big picture and get a global view of what is actually happening and what is the long-term view of the market. This situation has been made much worse because of the availability of tick data, the ability to chart every single trade that goes through the market. Every single small iteration of price can be charted. This almost hypnotizes traders, as does tickers running along the bottom of the screen. They're non-productive sources of information, whereas taking a step back is a very, very productive approach to trading. Finally, trade what you see, not what you think you see. So long as you can keep that as a central tenet of your trading system, you will be successful. I'm Christopher Tate. Thank you for joining me.